to our fourth webinar in this series of webinars. Today, originally last week when we put this on the calendar, it was because of the new amendments. And then we have a special guest that is agreed to join us on short notice. So I guess I'll start with introducing her. First you have myself, Adam Sweet. I'm a principal in Spokane, Michael Holdren in Des Moines. You've seen us a bunch, but we have a brand new face today. We have Jamie Wood, who is the district director with the South Dakota District Office of the SBA. And she's agreed to come and be on the spot and answer a few questions and maybe share some of her experiences with the PPP program. So I guess I'd start with welcome, Jamie, and thank you for joining us.
Thank you so much for allowing me to join in on this wonderful platform to share information. And I know we kind of made a last minute request to jump on here, but I'm really glad we could make it work out. And I look forward to going through some of this today. So as you said, there's a lot of wonderful updates that have come out that have expanded the Paycheck Protection Program. And I think it's going to be really beneficial to helping the small businesses. The airplane, as we said, has been being built all along, over the last few weeks. And we've listened and heard a lot of great feedback from the folks that are implementing it, the lenders, the CPAs, the business attorneys, and the small businesses, of course. All the feedback has resonated up to the top level, and it's helped to refine the program. So I think we're in a good spot moving forward, at least for now, as we're moving through and kind of coming out of COVID, but there's still a lot of need there for PPP, so look forward to it. And I'm broadcasting today from beautiful Sioux Falls, South Dakota, so I'm really glad to be able to connect.
Very good. Thank you, Jamie. And I see questions are rolling in. Many of these questions we're going to cover as we go. So similar to last time, there'll be too many questions for us to cover. But hopefully our material is pretty comprehensive. So hopefully the questions that are rolling in, we're going to address them as we go. So with that, the agenda for today, and really the biggest piece of the agenda today is last week. It seems like longer ago than last week, but really was just last week that the president signed into law what's called the Paycheck Protection Flexibility Act of 2020. It was passed by the House a couple of weeks back. I think the Senate passed it maybe a week ago, Monday or Tuesday, and the president signed it on Friday. And the key thing, I think, for everyone out there, that if you're a PPP borrower, is that this act makes material changes to the existing Paycheck Protection Program. And these are statutory changes. This isn't regulatory. This isn't new instructions. This is kind of bedrock change of the law. And then along with it, most of what we're talking about here, most of these changes are retroactive to the effective date, the original effective date. Now, there are a couple of exceptions, and we'll highlight those as we go. But generally speaking, as we discuss this new law, you can think about it as being in effect since the beginning, meaning that if you borrowed 2 months ago, generally speaking, this law applies to you, even though it was just passed last Friday. So the original statute, is everyone who's been with us now for the last 6-7 weeks, there's the concept of a covered period. And the covered period is the time where you can incur or pay eligible expenses, and then you add up all of your eligible expenses during the covered period. And if they had the right ratio and the right makeup, you could get forgiveness equal to those expenditures. Originally, that was an 8-week covered period per the original statute, and it began on the date of loan origination. The big change here is the new version now extends that covered period now to 24 weeks. So that if you actually looked into the law, the definition of the covered period, the standalone or default definition is 24 weeks. So big news, because that means now you have 24 weeks potentially to incur eligible expenditures, whereas before you only had 8 weeks. However, and Michael's going to talk about this here later on, we actually have more than a few clients who have borrowed and whose original 8-week period is coming to a close, and they are likely going to choose to apply the 8-week period, and Michael will go into that, why that is. But for those people, you can elect to apply the original 8-week period. So you're not bound. If you're you're ready to go, you've incurred your expenses, you can certainly choose that 8-week period to be done with it there. And I know there's going to be questions in people's minds about why would you do that. We'll go into that later in our slide deck. Along with that, so your mind starts the race. Ours certainly did last week. You're like, well, now we have a 24-week period. So what does that mean? Beyond having 24 weeks to incur eligible expenditures, how does that change the program otherwise? And one idea floating out there is whether that increases the amount of total payroll or salary expenses you can pay to an employee. The instructions we have out there right now state that the maximum you can pay to an individual employee is $15,385, and that's generally for non-owner employees. And the way they get there is the statute says you're capped at 100 grand, and 8/52 of 100 is that 15,385. So one question, and I'll throw it to Jamie here to put her on the spot right away. But is that limit now 46,000 per employee? Because if you use the 24-week period, 24 divided by 52 times 100,000 is 46,000, or is it still $15,385 per employee? So I'll throw you right into the pot, Jamie. Any thoughts on that?
Yeah, so we are, just to be clear, so we are still waiting on some final guidance to come out. Again, as the new legislation gets introduced and the questions at that implementation, the local points of the implementation points basically drive, more fidelity on how these are looked at, during the implementation, we're able to get more clarity. So we haven't quite gotten all of our guidance yet from headquarters that follows this legislation. But what I can tell you, I did some digging around our region for the expertise for the district offices across our region. There's 6 states in the region that I'm in, and posed some of these questions out there to the other district directors too on what they're hearing. And the way actually what we're looking at this as is that, and this isn't speculation, this is what we know is what we know right now. We haven't gotten any indicators that that 100K number has been extended. And what we do know is that along with the original formula to find out what the PPP loan amount would be, you take the 2019 payroll, you divide it by 12 and times 2.5. Okay, and we know there's some particular scenarios out there that might, that model or that loan amount will flex a little bit. Some people will be eligible for a lot, up to $10 million. Other ones will be eligible maybe for a couple $1,000. So there's a wide range in there. But that model, as far as we know it, and again, we haven't received official guidance yet, that model has not changed. So that loan amount is still going to be, based off of the same model that originally was supposed to be spent over that 8-week period. The only thing that really has changed that we know about is that 24-week time period. So now instead of having 8 weeks to spend it in, you have 24 to spend it in. So I don't have, the guidance that you're asking for on that number of what can they spend every month or every few weeks for that. But I do know that the loan amount still is based off of that original formula. So if you have $50,000 and you can spend it in 8 weeks, at least 60% of that, then you've met the mark for the payroll protection. If you can't spend it in less than 24 weeks, you have 24 weeks to spend it. So that's what the wiggle room is now. You have more time to spend the same amount of money.
So then kind of along with it, as I mentioned, we were brainstorming, what does this mean, 24 weeks? One of the other thoughts we had is maybe now, originally there was lots of talk about paying special bonuses to employees. Maybe employees were hesitant to come back to work because of COVID-19. Could you pay them a special bonus? And would that special bonus qualify as a payroll expense? And our advice, I think, was yes, subject to limitations for owner employees and subject to a $100,000 limit. But generally speaking, bonuses work and has the added benefit of when you only have 8 weeks, you get extra payroll from it. So now the thinking is, all things being equal, perhaps there's less pressure there to pay that bonus. Because, I mean, as Jamie mentioned in the last slide, your loan amount is 2.5 months of payroll for 2019. Now you have 24 weeks to incur eligible expenses, 5 or 6 months. So there is maybe now less of a push or less of a need to pay that bonus. And I kind of have a simple example down below where you had 100,000 of eligible payroll in 19, 2.5 times that's $250,000. You're averaging less this year, so you're down 20%. You're at $80,000 of eligible payroll. And you talked with Eide Bailey, and originally we discussed maybe you pay a special bonus to employees. But now that you have 24 weeks, even at $80,000 of eligible payroll, you'll likely incur enough expenses during that 24 weeks to get forgiveness. So it probably takes the pressure off all those common questions we got about, can I get an extra pay period in there? Can I get a bonus? Can I do X, Y, Z? I think we anticipate it takes the pressure off a lot of that there. And then probably the biggest point, and I'll put this to Jamie to get her thoughts on it, but it probably means that a lot more people will, at the end of the day, be eligible for forgiveness, just because the plain fact of there may be less planning involved. You still need, I mean, I caution there, you still need to pay attention to certain limitations, but generally speaking, because of this additional time, you might, we would anticipate more people will be eligible. Jamie, I don't know if you have any thoughts on that?
That's really the intent of modifying the legislation on this, really was to make it more user-friendly for the borrowers and keep that capital generation going during this, through COVID and then coming out of COVID-19, so that people had the access to capital that they needed, but in a smarter time frame that made sense for them. There's a lot of folks that are having troubles. What we're hearing, and I'm hearing this across the nation from district directors too, that are having troubles bringing their employees back on, line. I've talked to some restaurants here in South Dakota recently, and they said that either for personal health reasons or because people are afraid to come back to work, or maybe just the timing got all just off for their employees. It's been really hard to bring them on. Plus, the supply chain was disrupted for some of the service industries like restaurants, and so they didn't have enough supplies like meat, for instance, to keep providing all the food that they needed to. And so there's some fray taking place right now that's being worked out, but that all articulates back to getting back to that 2019 payroll. And it's been really tough for some, and others are doing okay with it. So I think that it's a real benefit to the small businesses to have these modifications in there, and we're pretty excited about it.
So, I mean, I think along with that, and I'll turn it to Michael here in a second for a comparison between the 8-week and 24-week, but who's helped by this 24-week period? I think anyone that's a recent borrower who didn't do a bunch of advanced planning for the 8-week period, they're helped by this because now they have 24 weeks. I mean, this is an overgeneralization, but maybe people who are not helped are people whose 8-week period is coming to a close very soon, and who maybe were planning all along for the 8-week and paid bonuses or made extra efforts to incur eligible expenses. All things being equal, they might have done things differently with the 24-week period, but it kind of is what it is now. Maybe Michael, I'll turn it over to you to compare the 8 versus 24-week period.
As Adam stated, you have the election to stick with the 8-week period, or you get the more flexible 24-week period. And our likely reaction, as we just discussed, is that most borrowers are probably going to likely lean toward the 24-week period, primarily because many have seen impacts, particularly to payroll and meeting those thresholds due to the stay-at-home orders or the shutdowns that have been impacting overall business operations. But with that said, the statutory forgiveness reductions relating to FTEs and salaries and overall reductions made during the covered period. And as we'll discuss in a few slides, the covered period is now extended to December 31st. So one of the questions that we have outstanding is, changing that covered period from ending June 30th to December 31st, will borrowers need to maintain FTE and salary levels either to the end of the year, December 31st, or for that 24-week covered period? And I think we'll likely wait for additional guidance from the Treasury on where that might end up. So if we look at the 8-week versus the 24-week period, why would somebody choose the 8-week period? Well, we've had the application for a couple weeks now. Many of us have been working with borrowers to help plan for that 8-week forgiveness application. And there is a level of certainty over the process as it stands right now. Obviously, a couple things are retroactively changed, but they're beneficial to the borrowers. We've got a reduction in the payroll threshold, along with a couple of additional FTE reduction exceptions that I'll discuss in a little bit. But generally, we kind of know or have some certainty over that process. So that might give a borrower a reason to want to use the 8-week covered period. Additionally, quite obviously, if you've expended all of your funds and you qualify for full forgiveness, there's likely no reason to extend this process and move into the 24-week covered period. Some borrowers may not want to wait or prolong this process, especially if there is a requirement to wait till the end of the 24-week covered period. So that might entice somebody to stick with the 8-week period as well. Additionally, the extended timeline could add some complexity to calculating FTEs over a longer period of time, just more information to juggle, as well as maybe potentially an additional amount of documentation that you'll be required to retain and submit. And quite frankly, some people are just ready for the process to be over. It's been long, it's been very helpful. It has been a stopgap, certainly to many borrowers, but that has come with some angst along the way. On the flip side, you'd probably choose a 24-week period. Obviously, as we discussed, if you need additional time to incur expenses, whether it be payroll or non-payroll related expenses. As we've worked with a lot of borrowers, initially, many borrowers also planned for a 30-hour FTE calculation based on some outstanding SBA guidance. However, the application came out and the FTE was based on a 40-hour work week for a full FTE. And that created some FTE reduction issues. Some businesses reduced employees down to 30 or 32 hours. So this 24-week period does give you a longer time frame to replace or reduce those FTE reductions and restore salary levels. And lastly, if you are operating at a reduced capacity, let's say 50%, this 24-week period does give you a longer time frame to continue paying that standard operating payroll without having to pay those additional bonuses that Adam had talked with. So essentially, you're being able to kind of cover your payroll over that longer period of time. On the flip side of that, also, if you're a less labor-intensive business, you potentially do have a longer period of time to cover some overhead costs as well, and you have a favorable 40% treatment for those non-payroll costs. So if a 24-week period is chosen, we would caution you to be prepared, as I mentioned, for some additional documentations, at least as it's required by the existing application. We do anticipate that a new modified application will come out. Whether that will require any additional or new documentation remains to be seen, but be prepared to retain and submit potentially a full 24 weeks of documentation for payroll and non-payroll related expenses. When you're completing the PPP Schedule A, the Table 1 does require you to list all employees who are paid at any point during the covered period. So extending that covered period from 8 weeks to 24 weeks, if you have turnover within your business, you could have additional employees and some additional documentation requirements that you might need to bring into play for those individuals that might be coming or going during the 24-week period. So one thing.
Sorry, Michael.
Yeah,
one quick question. No, that's okay. I was on mute and I had to take it off mute. Jamie, maybe just a question to you there. I mean, to Michael's point, we have the existing forgiveness application that's based on an 8-week period. Now we have a 24-week period. I mean, it seems like we're going to have an amended or a new forgiveness application. What are you hearing, maybe in terms of timeline, or what can we maybe expect there?
We were on a call nationally earlier this week, and there are indications that there will be a new modified application coming. It's not quite ready yet. We don't have it, but we do anticipate that there will be one, coming. So we'll have more guidance as it comes.
Stay tuned.
Yeah.
So, I know the Congress is keeping the SBA busy here. So as soon as you're done with one, it's kind of whack-a-mole. As soon as you've knocked one down, then another one pops up.
But it's all, it's all for the benefit of the small business, and we're learning as we're going. And, just really commend our senior leaders that are helping to make these programs available, and for you all too, to help us understand them better as we go. So hang in there. I mean, we're really just trying to get through this, and we're excited about this because a lot of businesses, have been struggling, but there's a lot that are coming through this and getting back in the saddle. And these, the PPP funds, and along with the Eide that we'll talk about later on in the presentation, are really meant to be really sharp, powerful economic survival tools in the toolkit for small businesses. So it's all good. It is a little painful, but we're getting there together for sure.
Thanks, Adam, for that question. So one piece of information that was not included in the new legislation that we thought maybe would be was the treatment of deductibility of forgivable expenses. Currently, they are still non-deductible as long as they are forgiven. An extension of that covered period to 24 weeks could create some tax return issues for year-end filers. In the essence of time, you can kind of, I won't go over this example in detail, but generally speaking, that extended time frame could push that forgiveness back beyond year end, which creates some level of uncertainty on what expenses could be deductible. And potentially, if a borrower has to wait until 12/31 to restore some FTE levels before they apply for forgiveness, obviously that even compounds or pushes this timeline back even further. So some open questions that we have in regards to the 24-week covered period. Can a borrower apply for early forgiveness, or do they have to wait till the end of the 24-week period or till the end of December 31st? Jamie, do you have any kind of guidance on if that's going to be allowed? Because clearly some borrowers may have 80% of their expenses incurred, and it's only going to take another 3 or 4 weeks versus a full 24. Will they be able to apply for forgiveness during the 24-week period?
Yeah, that's a great question. Well, the way that we're understanding it here in the field is that you can apply at any time for that forgiveness during the 24 weeks. However, we haven't received any other, further guidance than that. So once the guidance comes out, we'll have more clarity on it. But like you said, some folks might only need an extra couple weeks or 4 weeks to reach that 60%. It was 75, now it's 60. So it should be, that's a little bit, easier to achieve as well for the small businesses. So, and that relationship really is between the lender and the small business. That's where a lot of that negotiation takes place. So SBA is working diligently across all the different thousands of lenders across the United States as well too, to make sure that there's continuity in the understanding of that. So we should have updated guidance coming out pretty quickly on that.
Sure. Yeah, and that question really stems from the existing application. Right now, there's language in there that there's a practical expedient essentially for the FTE reductions, that if you have not reduced your number of employees between January 1st and the end of the covered period, which now has been extended to 24 weeks. So that's kind of really where that question stems from. So hopefully we do get some modified language in that application, which creates a little bit more flexibility for the borrowers. And there's similar language related to the salary reduction piece as well. And then the last kind of open question is, if you do elect the 24-week period, is there going to be an alternative covered period? Likely isn't necessary, just because the alternative covered period was really to help align payroll to match, your 8-week covered period. So if you have an additional 16 weeks of expense time, maybe don't need that in the 24-week covered period. All right, and I'm going to turn it back over to Adam to cover some additional new legislation.
Thank you, Michael. So along with that, the extension of the covered period was an extension of what you might call the expiration date of the PPP program. So originally the program was ended on June 30th, 2020. And that mattered for a couple of reasons. One, that's the latest you could borrow. But two, it also was if you were subject to a forgiveness haircut because you didn't have a high enough FTE count, one of the safe harbors to avoid the forgiveness reduction was to restore the FTE count by June 30th. Now that the date is December 31st, 2020, we're assuming that that is now the date for restoring the FTE, et cetera. Also, though, another interesting comment here, and I talked with Jamie this morning, it wasn't totally clear from the statute whether you could borrow after June 30th, because the new statute, the Paycheck Flexibility Program, I'm forgetting the name of the amended statute. What it said was that the program expires on 12/31, and that you can incur an eligible loan during the covered period. And some interpreted that to mean that you'd be able to borrow in August if you were a new borrower. But Jamie, I think that the powers that be in DC maybe answered that question a couple days ago or yesterday.
Some of the guidance that we do have on this includes a press release that did go out from the Department of Treasury Secretary as well as the SBA Administrator. And it's very clear on there. It says that in addition, the new rules confirm that June 30th, 2020 remains the last date on which a PPP loan application can be approved. So there are no additional funds right now after June 30th for this program.
And to highlight a point, I think people, and that there's still existing funding there. I mean, actually substantial existing funding for, if anyone's still thinking about this program, is it, I mean, I put in my slide, but I think that's correct, Jamie. There's still over $100 billion left.
There's actually a little more. There's $130 billion left of funding for PPP right now. So what we really do recommend to potential borrowers is don't wait for this. If you're feeling the pinch at all because of COVID-19, go ahead and get this funding in your toolkit to help ease the burden off of, this unprecedented time. I mean, that's what it's here for. It's to help, and there's no shame in this loan. And actually, I mean, this has hit the whole United States. It's hit the world, but this is, for American businesses and some of our territories that we work with too, Guam, Puerto Rico, Virgin Islands, American Samoa. So we, all of the states are eligible to apply for this. And it's based off of your 2019 payroll. There's a model that your bankers can help you determine what that loan amount is that you can get. And as long as you follow the parameters that now have been opened up even wider, they're even more user-friendly to the small businesses, it really makes all the sense in the world to get this buffer, this survival buffer in there. And then you can use your other operational funds that you may have for other operational expenses that are outside of PPP. There's certain parameters you can use the extra 40% on. It can only be used for certain operational expenses, utilities, mortgage interest, or your lease. And that could be up to 40% of it. And so, or you could use 100% of it on payroll. But the bottom line is you have to use at least 60% on payroll. So it makes a lot of sense to get it. There's 130 billion that are still out there. We've seen a little bit of a plateau from round 1 to round 2, but there's still a need here in South Dakota, for instance, from last week to this week. There were almost $3 million worth of additional new loans for PPP, 209 loans, extra loans. So that's still indicative that there's need out there. And we're hoping that people will leverage it.
So, and Jamie just mentioned it, but the other big change here with this new legislation was that now instead of 75%, only 60% of your payroll, of your eligible expenditures must relate to payroll.
Right.
And just by way of quick background, the original statute, actually, interestingly enough, the original statute was silent. All the original statute said was you must spend your loan on a bucket of categories. It didn't, the statute didn't say it must be on 80% on salary or 60% on salary. But the in Washington, D.C., the Treasury and the SBA interpretation of the intent of the statute is that you had to spend at least 75% of your expenditures on payroll in order to achieve forgiveness. Importantly, it wasn't a cliff rule, so that if you spent less than 75%, it was just a ratchet back. And I have a quick example there. You basically take your payroll, divide it by 0.75, and that gave you your total expenditures. But with oh, go ahead, Jamie.
To also caveat the intent, the original intent of the Paycheck Protection Program. I mean, it's embedded in the name. It's to protect the payroll for America and keep Americans employed and getting paid so that we don't have a catastrophic gap, in our economy. And that's really what this has been designed for. So raising that number, initially to that 75%, it really was a lever, if you will, to position it where small businesses were able to keep people employed and off the unemployment rolls. And so that's the whole intent of this, is to really keep the economy going, keep businesses going, but keep people in jobs.
So with the new legislation, it's 60%. It's interesting language, actually. If you read the statute, it says an eligible recipient shall use at least 60% of the covered loan on payroll costs. And some wondered, in fact, even some senators wondered whether this was a cliff rule. I mean, the presence of the word shall didn't seem to leave much debate if it was less than 60%. But fortunately, I think, and probably right from a policy perspective, yesterday the Treasury Secretary made an announcement that it's not a cliff rule. So that's a borrower-friendly result there. And so it's just the same as it was for the 75% rule. It's a ratcheting back. If you don't reach 60%, it's a ratcheting back of your total forgiveness. But I'm using the same facts as the previous example just to illustrate that when it goes from 75 to 60, suddenly you can achieve full forgiveness under our same set of facts, as I had 2 slides ago. So borrower friendly allows a borrower to spend more of their loan on what I might call overhead or non-payroll expense. One other question, someone asked this question, this is a question. The 60% rule applies both for the 8-week and the 24-week period. So think of the 75% rule is gone. It's now 60% no matter who you are. That's a good question. I had that same question.
So along with the change in the covered period as well as the thresholds, we also got some flexibility from an FTE reduction exception standpoint. So if we take a step back, the original legislation requires a borrower to essentially take a reduction, or they're subject to a reduction of their forgiveness if they don't maintain FTE counts. And those counts are compared to several reference periods as required by the statute. But there are some exceptions and safe harbors that are provided in the statute as well as the application. So the first outstanding exception, and this is not a new one, indicates that any positions in which a borrower has made a good faith written offer to an employee during the covered or alternative covered period, which was rejected by the employee, will not count against them from an FTE reduction standpoint. So this is an exception. They don't have to, they can exclude these from their FTE count. It is important to note that there was an interim final rule that did indicate that as part of this documentation, the borrower should inform the applicable state unemployment office within 30 days after such an offer has been rejected. So just a point to note there. The existing exception number 2 that's outstanding is any employee who during the covered or alternative covered period was fired for cause voluntarily resigned, or voluntarily requested and received a reduction in their hours also does not count against the borrower. A lot of questions we get here are planned retirements. If an employee retired during the covered period, does that count against them? No, that we're indicating that's a voluntary resignation in terms of a retirement. Now, the outstanding safe harbor that's also applicable is if the borrower reduced FTE levels during the period of February 15th through April 26th. So this is really kind of when all of those shutdowns and stay-at-home orders really came into effect. And the borrower restores FTE levels by not later than June 30th to its FTE levels for the pay period that included February 15th, they're granted a safe harbor. Essentially, they don't have to meet those FTE reduction requirements. So the question I would ask Jamie is, the original application and guidance indicates that those FTE levels have to be restored by June 30th. With the covered period changed to now December 31st, our borrower is going to have the flexibility to have up to December 31st to kind of restore those FTE and salary levels.
That is another thing that we need more clarity on, with the guidance. The way that it reads, it does seem that date now is the end of the year. So that's some guidance that we hope will be coming out with, some more clarity here in the next few days.
Sure.
So,
and I guess we're taking the interpretation too that if you did apply and use the original 8-week covered period, potentially you might be looking at that June 30th date. I guess obviously that's subject to interpretation and further guidance as well. So
yeah, it does. They did in that press release that I mentioned earlier that got sent out by Treasury and the SBA administrator. I mean, they do mention a safe harbor, and it just says provide a safe harbor from reductions and loan forgiveness based on reductions in full-time equivalent employees to provide protections for borrowers that are both unable to rehire individuals who were employees of the borrower on February 15, 2020 and unable to hire similarly qualified employees for unfilled positions by December 31st, 2020. So, and then, what we already talked about too, there's another part on that where if there is certain guidance that has come out from CDC, other health guidance that's come out that prevents a small business from being able to get their staff fully, forced back up. I mean, the force back up in place by December 31st, 2020. There's some safe harbor for that too. So we'll definitely make sure that you get that guidance as soon as we get it, and
sure.
That's all I have on that right now.
Sure. Well, and Jamie just essentially covered the information on our next slide there, so thank you. So yeah, we did get 2 additional FTE reduction exceptions, and she did just go over those. So essentially, a borrower, if in good faith, can document that they're unable to rehire individuals who were employees of the borrower on February 15th, or they can't hire similarly qualified employees by December 31st. Those do not count against them. And then also, as Jamie mentioned, if there is a requirement due to sanitation, social distancing, customer safety requirements related to COVID-19 that's in place, and a requirement by the CDC, the Health and Human Services, or OSHA, any inability to rehire staff because of those reasons is also excluded from counting against the borrower from an FTE standpoint. So again, as the statute or the legislation is named, this is creating more flexibility for the borrowers, and kind of adding to the ability to kind of reduce those haircuts that they might be subject to. Mm-hmm. Additional new legislation that we did get was the extension of the deferral period for principal and interest payments. The original legislation called for deferral of P&I for a period of not less than 6 months, but not more than 1 year. The new legislation allows for principal and interest payments to be deferred essentially until the lender receives payment of forgiveness from the SBA. So a borrower will not be required to make principal or interest payments until partial or full forgiveness is remitted to the lender. Additionally, the new legislation added some information that if a borrower doesn't apply for forgiveness, principal and interest payments will go into effect 10 months after the end of the covered period. So that is a new piece of legislation that was added. I'm not sure why a borrower would not apply for forgiveness, but in the event that that does happen, a lender would trigger principal and interest payments after 10 months.
We have received, very few, but we have received a lot of creative questions on how a business might be able to use PPP other than what it was intended for. And so there are some businesses out there that have asked us if they can use it to remodel or pave the parking lot, or do different sorts of things that they've wanted to do for a while for their business. And so we gently guide them back to the intent of the program is to bring your people back on and be able to pay them with a potentially forgivable loan as long as you follow the parameters. And so that's the true intent for PPP. It's not meant for anything other than what it is. However, if it is used outside of those parameters, it can turn into a low interest loan.
The last piece of new legislation that I'll cover before handing it back to Adam was the original maturity date of PPP loans was 2 years for any portion of the loan that was not forgiven. New legislation does extend that maturity date to 5 years. And that maturity date applies to all new loans that would be originated after June 5th. But it does also provide language that borrowers can renegotiate terms on existing PPP loans to match that 5-year term as permitted by the new legislation. So as a borrower, maybe this isn't as big of a deal because many of these loans will be fully forgiven given the 24-month period. But if for some reason you aren't able to reach full forgiveness, that is something, if you have a loan outstanding prior to June 5th, that you would need to negotiate with your lender to get an extension or a loan modification on those maturity terms. And Adam will take it over and talk about payroll tax deferral.
So another non-PPP related piece of the original stimulus bill passed by Congress was that an employer could defer its share of payroll taxes in 2020. Not the employee share, but the employer share of payroll taxes. And it, unfortunately, unlike PPP, it's not a free loan. You had to pay it back in 2021 and 2022. So one way to think about it is it's an interest-free loan from the bank or from the government providing cash flow this year, and you just pay it back in 21 and 22. The original legislation, as interpreted by the IRS, and I should have underscored that as interpreted because the IRS was pretty borrower friendly in giving this interpretation, was that a PPP borrower could defer payroll taxes up until the loan is forgiven. And at the point their loan is forgiven, they can no longer defer payroll taxes. The new legislation passed last week solves that problem for PPP borrowers, and it puts PPP borrowers in the same exact place as everyone else, whether or not their loan is forgiven, so that they can achieve full payroll tax deferral for the employer's share of taxes for the whole of 2020, even if your loan is forgiven in the middle of the year. So that's a borrower-friendly, taxpayer-friendly rule. So I thought we would close it here in the last 10, 12 minutes with kind of a couple of common questions we've been receiving, and maybe we'll bounce it over to Jamie as well to get her thoughts. But probably the most common question I receive is a version of what costs are eligible for forgiveness during the covered period. And let's look at payroll, for instance. The quote here is from the forgiveness application. And the forgiveness application said, borrowers are generally eligible for forgiveness for the payroll costs paid and payroll costs incurred. Notice that they didn't say for the payroll cost paid and incurred. They said payroll cost paid and payroll costs incurred during the 8-week covered period. Presumably that'll be the 24-week covered period when it's updated. But the crux of the question is this: is it truly a paid test or an incurred and paid test? And if so, what about payroll costs that are paid during the covered period? Do they qualify even if they were incurred outside of the covered period? And incurred means when were the services actually performed by the employee, not when they were paid, but so if an employee was working in March and you made payment in April for it, would that work? And the corollary question, I'll turn it to Jamie in 1 second, but the corollary question here too is, I mean, not the extreme question, but a lot of employers make 2019 retirement contribution payments in 2020, very common. Usually you must do it by the due date of your tax return. The tax return due dates have been extended to July 15th for everyone. So there's people that are actually making 2019 retirement contributions now. So the question is, and I won't put this specific question to you, Jamie, but generally speaking, what are your thoughts? Or is it a paid test, or how do we decipher that language?
What we believe here in the field, and this is what we've been advising people on from the beginning, because we have received this question many times, it's that it's for the life of the loan, so it's for the incurred during the life of the loan, and that time frame. Originally it was 8 weeks, now it's 24 weeks, so the pay periods would have to be for ones that are inside of that window. We haven't received any contradictory guidance on that allows for outside, expenses from outside of that window, but that's what we've been guiding our lenders here on in South Dakota, and consistently. So that's what we recommend.
Okay. It's interesting because we can never quite tell, and I'd say this is a remarkable period because everything is so fast moving. I work in the tax world normally, and IRS regulations, they can take years sometimes because they'll propose regulations. There's a notice and comment period. I'm sure SBA traditionally, that's the way it works too. And yet now the SBA is being asked to roll out with guidance at lightning speed. And so for those of us in the field, practitioners, we're always trying to figure out, are we reading too much into things, not enough into things? We hang, especially in the tax world, we're trained to kind of hang on every word. So Jamie, you get a glimpse now into our life.
Words matter for sure.
Words matter, that's right. And you can just never quite tell. Again, I mean, I give deference here to the SBA because they're having to move so quickly on this. This is not a normal thing where you would have a lot of time to get comments back before you finalize. I mean, you're having to truly make it up as you go.
Yeah, and I can, just as South Dakota as a snapshot again, we did the math last week, and collectively since PPP started, we've moved we with the lenders of course, but about 18 years worth of loans that we typically would do. It'd take us 18 years to do the amount of lending that's been done, in less than 10 weeks. And nationally, it's right up around there too, 15 or so years of loans nationally that have been done that typically, in just less than 2 months. So it's unbelievable. And yes, it's been moving very fast. Some folks might argue with it that it didn't move fast enough, but I think if it would have moved any faster, that would have been total chaos. And so this is really rolled out remarkably. And I think it's been incredibly responsive to meet the needs at the local level. So it's the program has morphed as we've gone to meet the needs of small businesses. And that's at the small businesses are at the heart. They are the essence of this. And SBA, Treasury, the White House, Eide, we're all on the side of small businesses and want our economy to succeed. So it's good.
So we'll put you on the spot here again, Jamie. The other question we've had from borrowers is this concept of the FTE and restoring FTE count. And originally, in fact, we can just actually focus on this language. Let's forget about the 24-week period. Let's just focus on the 8-week period. This quote I have, the existing safe harbor, is from the current forgiveness application. And it says basically, if you had a cut to FTE levels between February 15th and 26th, April 26th, as long as you restore those by not later than June 30th, 2020, you will not be penalized on the forgiveness stage. So the question we receive from borrowers all the time is, well, what if I restore FTE levels on June 20th? So what if I had cuts and I'm back to 100% on June 20th? Do I have to maintain it until June 30th? Or is it, the reference in the instruction says by not later than June 30th. So could you potentially use an earlier date? Jamie, have you heard anything, any inklings either way?
The intent of the program is to bring people back on and keep them. It's to keep jobs filled and keep people paid and keep people off of unemployment. So the answer, I think, lies within that. It's not a matter of bringing FTEs back on to take them back off again and get back into that same loop where people are forced to go without pay or become unemployed on unemployment. So the bottom line is that employing this sort of program, the PPP program, is a lot less expensive for the government than it is to have millions of people on unemployment. So we don't want to get in that cycle, where it keeps going. So our view at SBA is get them on, get them back on the payroll and keep going.
Makes a lot of sense. And then, pending further guidance and actions, I mean, Michael mentioned earlier, I think there's some momentum in Congress for making eligible expenditures tax deductible. I mean, we need Congress to do it. At this point, the IRS has said they don't have the authority to do it. So we'll see what happens with that. And then maybe more pertinent, and I asked this earlier, Jamie, but maybe just put it again, that everyone's going to be looking for updated guidance soon on this 24-week covered period. And maybe actually in some ways, maybe there's less pressure because the 24-week period is going to extend into the late summer and fall, I suppose. But maybe, a lot of the guidance I know has been coming out, in the form of frequently asked questions that are updated. I mean, have you heard anything maybe that there's additional FAQs that may come out, or what's going on behind the scenes in terms of additional guidance?
I hope they do. We kind of all get our information at the same time, and it is launched typically on the Department of Treasury website right there. If you don't know where it is, it's just a wonderful website. You can just do an internet search on your favorite search vehicle on the internet and just put in Department of Treasury and it comes up, and there's a COVID-19 link on it that you can click on. And I really like that site. I use it a lot. My staff does too. And the same information is also carried on updates on the SBA .gov/Paycheck Protection link as well, but it tends to be launched first on the Department of Treasury website, and they always have typically been adding the most fresh FAQs, the most recent questions right down at the end, the bottom, and so yeah, that's how they update it. And also the interim rules and everything is right there.
And we got 3 minutes left, so I want to make sure to hit this quickly. So another very common question we have from clients is a separate loan pack program through the FDA called the EIDL, the Emergency Insurance Disaster Loan. Do I have that right?
Yeah, it's an Emergency Injury Disaster Loan, EIDL. Yeah.
Yeah. So it's separate and apart from the PPP loan program. The biggest difference is you apply directly with the SBA. But maybe you give us an update on that. Jamie, just by way of background, we have a lot of clients that applied and maybe even applied 5, 6, 7 weeks ago and they haven't heard anything. So just what are you hearing about the EIDL and the processing of loans?
So the EIDL loan is a little different than the PPP loan. It does have some broader scope on it. It can be used in a lot of different ways. It can be used for payroll as well. Cannot be used at the same time as PPP for payroll, but it can be used for payroll. We did get over 5 million applications straight out of the gate for the EIDL. And So that has been a daunting solution set for SBA that we are mitigating. We've brought on thousands of employees to help process these loans and to also provide the customer service support needed by SBA's Office of Disaster Assistance, which is another separate sub-agency from, I work in the Office of Field Operations. And so they've been doing this, and there's a lot of SBA employees that are also detailed temporarily to Office of Disaster Assistance to try to mitigate these too. So we have several 100,000 of these applications have been processed. We are hearing from a lot of people that they're getting their loans approved. Originally, it was up to $2 million, but a few weeks ago, it was reopened on May 4th, actually, to just agriculture producers. And now the loans are, that we're hearing from all industries that are getting their notifications through email, because that's how you're first notified about the loan. They're up to a maximum of $150,000 right now. Now there's a grant piece of that called Eide Advance. And that basically is about $1,000 per employee, not to exceed $10,000. So if you have one employee, if you're self-employed, you're gonna automatically, as long as you check the block on your online application at sba.gov/disaster, you'll be able to automatically receive $1,000 Eide Advance, which will turn into a grant in your checking account, or the account of your preference. If you have 10 employees, you could get up to 10,000. So that's how that works. We do get a lot of questions on that. People are getting the Eide loans in their accounts now. So it is moving. And if you have an application number from when you first applied, that means that your loan is being, it's in the the lineup to be processed. You'll get receive an email notification. If you want to call customer service, the information is right here on the slide. It's a 1-800 number. Call them and you're going to get a customer service representative that will ask you for your application number and some other information about your business. And they'll tell you where it's at in the lineup. Some people are already being processed. There's also things that I'm hearing like there's not good account information in there for some of the applicants. So don't assume that everything's okay. Just go ahead and call if you have a question. And there's also a customer service email here too. You can always reach out to your disaster reps to get that information, but also your local SBA district office is there for you too. And you can find us at sba.gov/local assistance, one word, and put in your zip code and it'll show you where your local office is, and there's all the contact information on there. We're glad to help.
Well, we're at our hour, so I think we'll wind it up here. Amy, I think first and foremost, from Eide Baylor's perspective, we'd like to thank Jamie. She didn't have to do this, so Michael and I had to do this as part of our job, but we certainly appreciate Jamie specifically, and then the SBA more generally, taking the time to share their knowledge and experience with the program.
Oh, thank you so much. We look forward to future webinars with you too.
Thank you. And thanks to all the attendees as well, everyone that signed in. We appreciate your continued support. I know there were lots of questions that came in. As always, we'll try to get to those in a future webinar if we can. So with that, I hope everyone stays safe and we will talk to you soon.